So good afternoon once more, and thank you very much for joining us this afternoon. I've prepared a session for you guys. Hopefully, it will make a difference. But I've tried my level best to anticipate those aspects that you need most. Okay, so that is my anticipation. And thank you very much for those who gave feedback, who gave input into what else they wanted to see included in this class. So thank you very much. I have included as much as you guys suggested in the groups. So thank you very much. And I also want to tell you that we're going to have a discussion whereby it's not going to be in depth. We're not going to focus in depth into any particular topic, but we're going to give you an overview and a few demonstrations of how and how to deal with certain concepts, right? And you guys also have been going through the study pack in preparation. So if you have any questions at the end of this presentation, or we can focus on some of your questions in the study pack, and then we're going to conclude. Right, so I'm a private tutor from Resource Hub, and we do offer tutorials at third level. So if you are interested in our tutorials, um, you are welcome to send a message to our team, right? And we will be happy to help you during the year. Right, now we getting started. So you guys know the test one topics. It's always interesting because you will find a few students even now asking, what are the topics to be examined? So that's a bit interesting. What are the learning units for test one? Um, is this going to be examined? Is income tax is going to be examined, and so forth? So that's a bit interesting. Okay, so we will for test one, we're going to be examined on the conceptual framework, examined on income taxes, examined on revenue as well as on leases. And the feedback you gave me based on your lecture is that you're going to be examined on the lessor, right? So most recently, this has been the case because lessee is assumed to have been covered sufficiently at second level. Right, so these are the topics that we're going to touch today, and we're going to touch some of them more than others. But I just want to talk to you about your approach to studying. So a standard examination paper, a standard examination paper, or extended examination question paper will have something like 20 to 30% stuff that is going to be easy. You can say this is very easy. And we do expect everybody to get that 20 to 30%. Then you're going to have something like uh, 40 to 60, right? 40 to 60% of a paper should be standard at your level, very easy. At your level, very manageable. When I say easy, I mean if you take somebody from second level, they might be able to get 20% because they can calculate depreciation, they can calculate a few items and then get stuck. But then at that level, you learn new things at your standards. So you'd expect 40 to 60% of things at your standard, which are not difficult, but at your level. And then you would expect right, about 10 to 20%, right, of things that are going to be difficult. Now, this will be difficult. And you can expect something again like a 10%, around 10%. So you said 10 to 20. Right. And then you can expect a 10%, plus or minus 10%. Now, this is exceptionally difficult. This is complex, right? And things like when examiners give the test to like 6,000 students, then they'll expect about 30 students to get this right, the 10%. And maybe 100 students to get or maybe 200 to get the difficult part, right? But then they expect almost everybody to 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 do well in the easy and standard stuff. So when you study on the basis of a return on investment, right? How much time are you going to put in there in the study, and what is the reward? So when you study, you should focus mostly on the basic stuff, the basic and standard stuff. Okay. Then you're going to have the stuff which is difficult and complex. You don't have to worry about that unless you have the time, unless you have the capacity, and you can manage that as well. So for the vast majority of students, you look at how much effort is required, how much time is required, and what is the return on that investment. You're going to invest your time, you're going to invest your effort, and then it's only worth 10%, plus or minus, maybe less than 10% of what will be examined. So you would spend like 2 weeks trying to understand something that is very difficult. So rather focus on the basic, on the standard. And you wouldn't spend so much time on the standard, and then you should be fine. All right, so that is the approach you should have. But now this is general because now you would ask yourself, so which one is the basic? Which one is the standard? And but it depends on you as a student, what you find difficult. Generally, if you look at topics like income taxes, then you have things that have to do with rate change. Then we want to write a rate change, which is a bit tricky. They want to talk about things that have to do with, for example, I think I can assessed losses, yeah, utilization of assessed losses. You know, those are a bit complex, a bit difficult for most students. And you may not have to spend so much time grappling with that, but as much as you'd spend time tackling current tax calculations, which is the basic and the standard. Right, so we're going to start our discussion. Just so you know, this is being recorded and it will be available on WhatsApp group as well as on Telegram. So you're going to get it. It's going to be made available. All right, so let's talk of the conceptual framework. So with the conceptual framework, the basic standard or the basic expectation the basic standard, the basic expectation is that you should know the definition of the elements. Not so. So you should be able to define income, Um, Defining recognition criteria for income, assets, liabilities, equity, and expenses. In most cases, we are normally examined on assets, on liabilities, and I sometimes on equity and on expenses as well as on income. But we don't quite normally get examined on equity, but it does happen a few times that it could be included. So you need to be prepared. The answering style, I think in the question bank, is it the question bank? It is the study pack that you use. Um, so in the study pack, you have questions that demonstrate how you answer that. So I think you should be fine, especially with assets and liabilities. So what I've done is that I just prepared one, and we're going to focus on expenses. Okay. So here is an example that we have that deals with the recognition of an expense. So we have an entity XYZ Limited. They contracted a professional cleaning company, right, to clean their newly acquired garage for 5,000 rand before they started using the facility to store their goods. Okay, the invoice for the cleaning services rendered was paid for after 31 December year end. So the payment was done after year end. Okay, and then the question the required said, to motivate with reasons if the cleaning services should be recognized as an expense in terms of the conceptual framework. Right, so as you guys know, or as you guys should know by now, when you deal with the recognition or definition, you start by stating the theory, right? Right. So this was a practical answer. I do not. I want to apologize because this is these are questions harvested from a lot of sources, so I won't be able to remember where exactly I got what. I'm supposed to mention where I get that as part of the acknowledgement, but I do not always remember because it's a lot of them. So the starting point here is to explain the process of recognition. Right? Firstly, how do we recognize an element? Right? Here they say step one, you mentioned the definition, but that's not where we start because this is a particular answer that was provided for that purpose. But a more comprehensive and complete approach is you need to mention that things are going to be recognized or elements will be recognized if they meet the definition. Right? So it has to meet the definition. So this is what you're going to state. It has to meet the definition as well as the recognition criteria. Okay. Of each particular element that is being or that we are looking at. And then we now start by stating the definition of what we're looking at, right? Whether it is an asset that we want, you will need to know the definition from the top of your head, right? You need to know the definition of a liability, and then we can follow that. So the definition of an expense. So expenses you define, and the expenses are defined as decreases in assets or increases in liabilities. Okay. And these have the effect of decreasing equity, but they are not a direct result of distributions to holders of equity claims or to shareholders. So that's the definition of an expense. And you have this knowledge because your 30 and other previous questions have demonstrated to you how do you structure your answer. There must be a logical flow of ideas. Okay. There must be a logical flow. So that is what you would do. You'd provide a definition. And then we now need to also look at what we consider for recognition. Okay. Now, with an expense, it's different from an asset or a liability because the recognition of an expense is triggered by, so occurs at the same time. So the recognition of an expense is triggered by either the initial recognition of a liability or a liability was already recognized and is now increasing. The carrying amount of the liability is increasing. So the recognition of a liability or the recognition of an increase in the carrying amount of a liability will trigger the recognition of an expense. Or it might be an asset being de-recognized that will also trigger, that could trigger, not that it will, that could also trigger the recognition of an expense. Or it might not be a de-recognition of the asset, but just a decrease in the carrying amount of that asset. Okay. So in that regard, we can also recognize an expense. So we can now look at an expense in terms of whether we should recognize a liability or whether we should de-recognize an asset, or because that treatment will trigger the recognition of an expense as well. So as we are discussing here. Okay, so we now look at, in this case, there was no payment made, right? Okay, so we can talk in terms of a liability because no payment was made. As it says here, the invoice was paid after year end, so there was no payment made. So the recognition of the liability will be discussed. The recognition of the expense will be discussed from the perspective of the recognition of a liability. So we do recognize a liability if it results in relevant information as well as faithful representation. In other words, if the information is going to be useful to the users of financial statements. Okay. Right, so that was just the setting up the theory. Now we go to the application. So do we see a decrease in assets here, or do we see an increase in liabilities? So the cleaning service that was provided will increase accounts payable or trade payables, which is a liability, until payment is made after year end. So what that means is, if this was a cash payment, we would see, if this was a payment in cash, we would see a decrease in an asset, which is bank, or any other economic resource if we're going to make payment using other assets. Okay, then we would have a decrease in that asset. But because no payment was made, we're looking at a potential increase for a liability. So there is indeed a liability arises because payment was not made. Right. So we do not see we do not see a decrease in assets. But remember that whether it's a decrease in assets or an increase in liability, it should result in a decrease in equity. Okay. But that should not be as a result of distributions or dividends. Basically, we could say dividends to holders of equity. So the increase in the accounts payable will decrease equity, and it satisfies the criteria that it should not be a distribution. And this does not represent distributions to holders of equity. So So this is your basic accounting equation, isn't it? Assets is equal to equity plus liabilities. Or assets minus liabilities will give us the equity. Okay. So if liabilities increase, this is going to decrease. If assets decrease, this is also going to decrease. Then, so we see that it meets the definition of a decrease in assets or increase in liabilities, which results in a decrease in equity. Then the recognition criteria is now based on the recognition of a liability. So do we have a present obligation for the entity to transfer an economic resource into the future? So this cleaning service will be settled later, right? And we could recognize an expense if the initial recognition of accounts receivable represents a present obligation to transfer cash. So we have a present obligation. The entity currently it has a present obligation to transfer cash in the future. So we can recognize a liability. Okay. And as we recognize a liability, this is effectively an increase in the liabilities, right? And that would meet the definition of an expense, right? Because an expense is an increase in a liability or a decrease in an asset. And then we look at whether the recognition is going to be useful about the liability. Remember that when we talk of relevant information, we're talking of whether there is existence uncertainty. In other words, does the thing really exist? So we do have an invoice to indicate that it actually exists. And we also look at the outcome uncertainty to say, is there a probability of cash flow? Right. Even though it could be low, but still, as long as there is a probability, then it's going to be relevant. But in this case, the probability is definitely not low because we expect to pay this at the end of the year. So this relevance aspect is resolved in terms of, firstly, this thing actually does exist, and there's a good chance we will make a payment for it. Of course, we are intending to do that at the end of the year. Then, is it going to be a faithful representation? So faithful representation deals with measurement uncertainty. Can we measure the amount correctly? So that's one aspect of faithful representation. Can we measure the amount? Do we have a reliable amount? And secondly, is there going to be a mismatch, right? An accounting, a recognition mismatch. Okay, that's also a concept of faithful representation. So we have a reasonable estimate because the invoice is invoiced at the cleaning is invoiced as 5,000. So we don't have a problem with that. At what amount should the expense be or liability be recognized? And to avoid a mismatch, because if we do not recognize a liability now, we will have to make a payment later. And then against what are we going to recognize the payment when we make the payment? Okay. So to avoid a mismatch, we have to recognize a liability now. And so that will lead to a faithful representation. So in that regard, we then make a conclusion that this should be recognized because it meets the definition of an expense and the recognition requirements. Okay. I do not expect this to have been something of a revelation to you. That's not my expectation. Because this would be the basic things where you should harvest the marks. So when it comes to questions of conceptual framework, definition, recognition, you should get all the marks correct. But so generally, the examiners are going to ask you on whether something is an element and whether it should be recognized, right? Um, so you should collect all the marks there. Sometimes they will ask you whether it meets the definition. So you must stop there on the definition, whether this is an asset or not. Sometimes they ask you whether it should be recognized, which means we have to look at the definition as well as the recognition criteria. So we need to pay attention to the required. Okay, so I would expect you to have, as you prepare for the test, a template that you will use for assets, for all the elements, assets, liabilities, expenses, income as well. You must have a template for income and an example which you can quickly refer to, and equity. All right, so that was the first part of the stuff. Then if we move on, we're going to go now to income taxes. So the income taxes, there are a few things that we need to focus on. So income taxes is basically our current tax as well as our deferred tax. Okay. And you guys gave me feedback, so I thank you very much. It's very interesting actually that you're going to be, the lecturer said they will examine you on the income statement approach, not on the statement of financial position approach. Okay. When determining temporary differences, they will use the income statement approach. Although the accounting standard, the ES 12 recommends the statement of financial position approach. So when I studied accounting as a student, we were using the income statement approach, and it was very enjoyable. And that was um, in the late 2000s. And so the last time I was teaching deferred tax, temporary differences using the income statement approach, I think that was like 2013. I think that's the last time I remember, or 2015 there. But from 2017 on, I never touched on the income statement approach. So yesterday, the students told me that it will be examined. And so I ran around and tried to prepare something. And goodness, uh, it was a tough battle because I had forgotten everything. It's like 10 years back, more than 10 years back. And I had to, it was quite a battle, but I managed to prepare something and I'm going to share that something with you. It's quite comprehensive. And I did my best to check to make sure that there are no mistakes there. And I believe that there are no mistakes. But if you do happen to find something, please do talk to me on Telegram or on WhatsApp. But I believe that I've done correctly. Right. So with ES12, it's about current tax. You need to know those exempt differences, right? Very easy. Exempt differences are very easy. But students tend when the question says, normally the starting point is to adjust the profit before tax. So you will be required to adjust. It's either some transactions were not recorded or they were recorded incorrectly. And then you need to make adjustments to the profit before tax according to the accounting standards. And then there is a problem of students when they are required to adjust the profit before tax, then they adjust the profit before tax using the exempt differences. And that's already a tax adjustment. So when we are required to adjust the profit before tax, right, we are looking at amounts that were not recorded, which should have been recorded. or amounts that were recorded and were recorded incorrectly. Basically, we are saying that's wrong. Okay. So we need the correct accounting treatment of transactions and events. Okay. Then after adjusting for the profit before tax, uh, then we can now focus on adjusting for the exempt differences, which we will remind you, and for the temporary differences, which we will remind you again until we come to the taxable income and current tax. Then the other thing that you should know about uh, current tax is the provisional taxes, right? So coming from UNISA, you guys have done tax 2601, or wherever you are, you shouldn't reach third level without having touched some taxation aspect before. So provisional taxes is a method of collecting taxation, right, from companies. So companies pay every 6 months or whatever arrangement there will be, anticipating that they will incur current tax later in the future. So they pay provisional taxes during the year against their future income tax obligations. Okay, so you need to know the journal entries for provisional taxes. And a question could say, calculate current tax expense. So you just calculate the expense. Sometimes the question says, calculate the current tax due or calculate the current tax payable. Now, they are not just requiring you to calculate the expense. They want you to calculate the due portion, the portion due, the portion payable, which is still outstanding. So you are going to say your expense here, and then you deduct your provisional taxes that were paid. Okay, and then you have your current tax due or current tax payable. But sometimes you also need to pay attention here. In the provisional taxes, there might be some penalties, right? Or fines or interest that is paid for non-compliance, right? And you paid to SARS together with the provisional tax, right? With the provisional tax payments. So maybe we might have violated some something to do with SARS or the Income Tax Administration. We have violated the rules, then we are penalized by SARS. And when SARS charges us, then we just decide to pay together with the provisional tax. So remember, that's not going to be part of the provisional taxes. You need to exclude that from the provisional taxes. And when you exclude it, then you need to include it in your adjustment of profit before tax, because it's an expense that should be deducted from profit before tax. And after deducting that from profit before tax, you need to remember that it's also an exempt item. So when you now want to calculate the taxable income, you remember that that fines, penalties, or interest is also exempt. So you need to adjust for it. So first of all, you will use it to adjust the profit before tax because it's a legitimate expense of the entity, but it's not deductible for tax purposes. That's why it's going to be exempt. So provisional taxes is not an expense, right? It's a contribution towards paying the final tax bill, but we pay in advance, right? Provisionally. That's why it's a provisional. Then just thinking, I didn't check in the last 2 years, including, and this will be the third year. I haven't checked in 2026. I didn't check in 2025. I didn't check in 2024. But it's not a lot of things, though. Dividends tax. It's normally, from my previous knowledge, it has always been part of the what we study in years 12 income taxes. And then you, in that regard, so I would advise you to do a quick check. Right. But as you do a quick check, this is dividends tax, not dividend income being exempt from normal income tax. There's a difference between income tax and dividends tax. Dividends tax is separate. So if an entity pays, dividends, declares dividends, right? So there are dividends that have been declared. Um, Dividends for shareholders. So it has declared that it is going to pay 100,000. This will be in your statement of changes in equity or statement of financial position. And at that level, you must always indicate to which financial statement that entry belongs to. Then I want you to remember just one thing. You won't know everything, but know that natural persons, people, right, uh, pay dividends tax 20%. And companies don't pay dividends tax. But I want you to just know that they are exempt from paying dividends tax. Okay, so if we are paying to 40,000 of that is being paid to natural people, then I will say 20% of that is dividends tax that should be paid to SARS. The rest is going to be dividends payable. It's going to be the balancing figure here. But for the dividends that are going to be paid to natural persons, 40,000, say, for example, if we are paying natural persons 40,000, then I think 8,000 is going to be a payment due to SARS in the statement of financial position as dividends tax payable. Then the balancing figure will be 92,000. This will be the dividends payable to the rest of the shareholders. Right. So last time I checked, this was always the case. It was part of what you guys study and what you will be examined on. Right. So I was talking about the knowledge of current tax and deferred tax, and also the tax rate reconciliation, which is very easy, very, 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 very easy. But we're not going to discuss it now. So what we're going to do now, we're going to talk about some of the exempt differences. So what I've done, I've prepared a template for you, right? So our starting point, when we are required to calculate current tax, our starting point is the profit before tax. If there were any adjustments to that profit before tax, then the adjusted profit before tax is our starting point. And then we adjust for exempt differences. Exempt differences are also referred to as permanent differences. This is, if it is income, then the income is not taxable. Not taxable means it should be excluded from the final amount on which tax is going to be paid, called the taxable income. So the taxable income is the final amount from which we are going to pay tax. Right? Taxable income, then we apply the tax rate to the taxable income. So if something is exempt and it is income, then it should be subtracted. If it is an expense and it's non-deductible, then it means we would have included that as an expense. when calculating profit before tax, and that is correct. But now, for the purposes of calculating taxable income, SARS says they do not want to see that amount there. You have already deducted it in calculating profit. You must add it back. So the non-deductible are going to be added back. Non-deductible expenses. So I've given you a list, and I want to believe that you have this list already. Do you not? Dividends income should be removed because it's not taxable. So if it was income that was originally included in profit before tax, and the effect of the inclusion was to increase profit. So the figure we have as profit before tax here includes a plus from the dividend income. So if we want to remove the effect, we're gonna subtract that effect, right? So 20% of the capital profits, which is not taxable, we deduct. Then any fines, interest, and penalties for non-compliance. This is not just any interest, not a finance charge. It's non-compliance. You are being penalized. This would have been deducted as an expense. It has to be added back. SARS says, no, you don't reduce your taxable amount with that amount. If there are donations which are not deductible, we donate and then we are told this is not deductible, we add the amount back. And if there is foreign income and we are told it's not taxable, and it's almost always the case that it's not taxable, then we have to remove it. We have to exclude it by deducting it. And remember, we include gross. But sometimes we are told that we received 30,000 from Namibia, and this amount is after paying 2,500 taxes. Okay? So this will be the net amount, and this will be the gross amount. So you need to read carefully to understand that. The question could say they received 30,000 after payment of 2,500. So that would indicate this is net of taxes. Then you need to add back the taxes because we want the full amount before tax, the gross foreign income, right? Then we can have, so these are examples of the ones that are popular, but we can have a whole lot of other non-deductibles, non-taxables. So anything that is non-deductible as an expense, we need to add it back. So we might be told that there's legal fees and they are capital in nature. They have to be capitalized. Right? And we may be told that 45% of the fees is capital in nature. Then that 45%, which is capital in nature, is non-deductible. And we need to add back the portion that is non-deductible. Then by generalization, again, we need to deduct all non-taxable incomes. Whatever we are told, this income was received from government or from wherever, it's not taxable. We need to remove it from the profit before tax. Don't worry about the research costs. Should you worry about them? Don't. And depreciation on assets for which we can't claim capital allowances, where capital allowances are not allowed. And then we have depreciation on those assets, like your office buildings, your administration buildings. I'm generalizing to say, if you see a commercial building, like a warehouse, a manufacturing building, a factory, so those are going to be tax deductible. But if you see something like an office building, an administration building in general, that would make you expect that these are exempt. So sometimes it happens that the examiners do, whether it's deliberately, I'm not sure, or it could be deliberately. It could be that they overlook that. They may not mention the tax treatment of office buildings. They may not mention the tax treatment of administration buildings. And in that regard, then you need to consider office buildings and admin buildings as exempt all the time, right? Because that's the default position. Okay, so I'm saying in case they don't mention, but in most cases they mention that no tax allowances are allowed on the office building, then you know it's exempt. Then if you have depreciation on that particular asset, that depreciation would have reduced the profit before tax, because the depreciation would be an expense. And then you need to reverse that and add it back. Brilliant. And then you have the sum total of your exempt differences going to affect your profit. Either it's an increase or decrease depending on the sum total of the net amount you have there. Then after that, you have your profit after exempt differences, or you can say taxable income after, or profit before movement in temporary differences, whatever name. So these are your standard exempt or permanent differences. And all permanent differences are reconciling items. So when you do your tax rate reconciliation, you will remember that all this stuff is going to be reconciling items. You're going to apply your tax rate to those items that were exempt differences. And to the reconciling items, you're going to add an over or under provision, right? You're going to add a rate change. And then you're going to be complete in your tax rate reconciliation. That is as far as I can remember for now. Okay. And just a reminder, when you do with your over or under what provision, you don't apply the 27% because it's this over or under provision of income taxes is already at 27%. Is the amount that has been over provided for or under provided for after multiplying by 27%. So you don't have to say 27% of the over provision or 27% of the under provision. You just take the over or under as it is and you put it here. The same applies to the rate change, but you're not going to say 27% of the rate change. You're going to just include it. And like I said, then there could be things like these which are slightly difficult. You see, if you do a tax rate reconciliation, there could be the obvious stuff which is easy, then the slightly difficult ones. Remember the return on investment. How much time are you investing in how much effort are you investing in there? And maybe rate change will just come with 1.5 marks. And so you might have spent like 10 hours in total trying to get to understand this little thing. What actually happens with the rate change? And you struggle and grapple, and the sum total of your efforts is 10 hours, and it comes with 1.5 marks. And then you confuse it and you lose. So what's the return on your investment? So please do focus on the standard things that are not at the tail end of your difficulty. So I do expect that you guys should never have a problem with that, these exempt differences, not even one of you. Then from the exempt differences, we come to the calculation of current tax using the income statement approach. Like I told you, this was, for me, it was a huge struggle. It was a huge struggle, not because it's difficult. It's much easier, actually, than the statement of financial position approach, except that you were not prepared during from January, February, March, April, nobody was telling you that. So you were not prepared. But if you would be given a choice, this is the best because it makes sense. You can actually see the sense and the logic that it makes. Okay, you can actually agree with exactly what are we doing here. I last taught this thing in 2018, 2015. So I can't believe that. I had to remember some of the things from my tutorials then. And I had to revisit some of those notes. I was lucky because I did get a few, but I was lucky. But it's fine. So this is where we are. So after dealing with exempt differences, right? And then we have taxable income before movement in temporary differences. Here is what the lecturer said you should know. This is the income statement approach. You are lucky because I wouldn't have given you this slide or this presentation if it was something from the beginning. But because I also hadn't prepared it for my class, so you are going to be lucky. This is something that I reserve for class generally. But I did not teach my classes well, so I'm going to combine that for everyone. So what are we doing from the income statement approach, what are we doing to calculate taxable income? So in the income statement approach, we are looking at those income and expenses that were included in our calculating profit before tax, right? So we have income, dividends, we have interest, we have whatever it is, all income that was included, all expenses that was included, right? And now we say these were included from the perspective of SARS, right? No, my apologies, I want to apologize. These were included from the perspective of accounting standards. So according to accounting standards, that is indeed correct. But now we need to determine, based on those amounts, based on the profit before tax we have, what the final amount, the taxable amount will be to SARS. Now we need to carry on adjustments. So what that means is there's stuff that was included in the profit before tax, but a different amount should have been included instead of that amount. That's why we say it's a temporary difference. It's not like it's exempt, like it should never be. It should be, but a different amount should be. So let's say we included in profit a certain amount, but SARS wants another amount. So let's say we included income of 10 here. SARS wants us to include 20. So we have to reverse what we included and actually include what SARS wants. So we're going to make adjustments of what we thought is correct to accommodate what SARS wants. So in this profit before tax, we would have included depreciation because it's an expense of PP items with tax allowances. Remember that the other depreciation, where there are no tax allowances, it will be an exempt item. Now, for that where there are tax allowances, it's a temporary difference. So we need to add back the depreciation of PP items with tax allowances. And why is that the case? Well, this is interesting because SARS says you calculated the depreciation based on your own depreciation policy. SARS has their own tax depreciation, which we subtract. So we had subtracted this, we need to add it back. So we need to add it back and wait for instruction from SARS. And the instruction says, now you can deduct the wear and tear, the tax allowances, or the tax depreciation. This is done for taxation purposes. Okay. So I'm not sure if this will completely make sense to you because it's a short space of time, but I hope it does. Then we have profit on the sale of assets. right? Remember that this is, we have already dealt with capital profit. Because capital profit is dealt with here. We've dealt with that. The profit above the cost is dealt with here under exempt differences. Now we're talking of the profit below the cost or from the cost below. So we are going to say the selling price. Why did I say the selling price here? Well, yeah, it's correct. The selling price minus the carrying amount. But this selling price is up to the original cost. So it's the selling price. Maximum of that selling price should be the original cost of the asset. So the selling price that you include here in temporary differences should not exceed the original cost. Because if it exceeds the original cost, it comes here under capital profits. Remember, capital profits means the profit above the original cost. So everything here is to be below the original cost. So if the selling price is above, then we're going to limit that selling price to the original cost. So if the selling price is above the original cost, then here we can change and say the original cost minus the carrying amount. That profit should be removed because SARS doesn't want that profit included like that. So you must remove it. That's why we subtract it. And SARS says you must add back what is referred to as recoupment. So recoupment refers to the same selling price limited to cost minus the tax base. Right. So if the selling price is above the original cost, for recoupment purposes, we're going to say the selling price limited to the original cost minus the tax base. This is what we include for taxation purposes. And we have contract liability. Contract liability has to do with things like your refund liability, your customer loyalty, your allowances for settlement discount granted. Those are contract liabilities. All those things are contract liabilities. Okay, so we need to add back the contract liability for the current year if we get it, because it will be taxed this year at the earlier of receipt or accrual. And then the contract liability for last year should be subtracted because it was taxed last year already. But this year it has been included as revenue, but the taxation portion was done last year. So we should exclude it. Okay, and if there's any assessed loss from the previous years, we must also subtract it. And the same applies to in a case of a loss. If we sell an asset on loss, we need to add back the accounting loss and we deduct scrapping allowance. Scrapping allowance is the selling price minus the tax base. Right? The loss you make if the selling price is below the tax value, it's called scrapping allowance. That is what you are allowed to deduct. You're not allowed to deduct accounting loss. You're allowed to deduct tax loss. Okay, so you will have this and use it. Then we might have prepaid expenses last year. Remember, I said to you, for prepaid, I'm sorry, you are not in my class, but prepaid expenses, all of them you need to deduct them in the year that they are incurred. But when you go to fourth level to CTA, then you can also apply the 100,000 limit, the 6-month rule. But for now, every prepaid expense for financial accounting purposes, for the current year, we need to deduct. And for the last year, because we deducted it in the previous year already, we need to add it back now. Right. So last year prepaid expense, add back. current year should be deducted for the purpose of determining um, um, for the purpose of determining the taxable income. Then lease payments received. So because they said we're going to do the lessor, so any lease payments received, the actual payments received will be included. Okay, and but the finance income recognized using the amortization table, where we calculate the interest rate implicit and all that stuff, that should be excluded. We actually include the actual payments received. Okay. And then there's a wear and tear for leased asset. So let's talk of a finance lease. Okay. And we still have the asset, right? So uh, with the finance lease, we don't have the asset, right? With the finance lease, it is an operating lease that we still have the asset. But with the finance lease, we have transferred the asset. So we have recognized it. The asset is no longer in the accounting records. All right. But we're still allowed to deduct wear and tear because we are the legal owners. The thing is registered in our name. So what SARS says is you can deduct wear and tear for that thing which you have leased, right? For the asset you have leased, but you can deduct using Section 11E and Section 12. But you are restricted by Section 23A to say you can only deduct. So the maximum deduction you do in a year is limited by the payment that you're going to receive. So if you are receiving 2,000 and the wear and tear would be, you could claim 5,000. You are not allowed to claim the 5,000 because you are claiming 5,000 on an asset and you're receiving 2,000 on the asset. So the maximum you can claim is the lower of these two. Is that correct? Did I say that correctly? Yeah, the lower of these two. Right. So in this case, you are not allowed to claim 5,000, even though the way in TSS you can. You are limited by Section 23A to say up to 2,000, which you are receiving. Okay, I have an example that I'm going to demonstrate. And after that, we aren't going further. Then we have, right. So this applies to operating lease as well as the finance lease. We're going to add the actual lease payments received, whether it's operating or finance. And any, in this case here, the finance income for an operating lease would be the equalized finance pay, the equalized one. Remember, the straight line, then you equalize. This finance income recognized will be in the profit or loss, but for tax purposes, you need to exclude it. You are taxed on the actual amounts received. Right. That applies to both the operating lease and the finance lease. Then the wear and tear, obviously, this one applies to the finance lease. Then for an operating lease, sometimes we capitalize, not sometimes we capitalize. Well, yes, but let me say we capitalize the initial direct costs, right? But in many cases, SARS would want you to do an immediate deduction rather. So those initial direct costs, which will be capitalized in an operating lease, they're going to be subdeducted immediately. So you need to check which year did this occur. Because if the initial direct costs were incurred last year, then they were deducted immediately last year. You cannot repeat the deduction again this year. But then when you amortize the initial direct costs, which you capitalized for an operating lease, that amortization expense needs to be added back. That amortization expense needs to be added back for the current year. Right. So if we have any provision for anything, provision for that, provision for this, the current year provision should be added. Right. And the last year provision is going to be deducted. We can have provision for refunds, provision for warranties, provision for employees, whatever, any provision. Then allowance for credit losses last year, the accounting amount for last year, for the current year rather, should be added to, right, should be added back. Because it was deducted, should be added back. Then the one for last year, the allowance for credit losses, the accounting figure, should be deducted, right? And now the allowance for credit losses based on taxation, the 25%, the current year times 25%. This is now what we deduct during the current year. And the one for last year, the 25% times the prior year accounting credit losses, this one is going to be added back. Right, so you need to take a screenshot of this template or just write it down by yourself. And if you have any questions, you can ask your friends, you can ask Google, you can ask AI, you can ask the lecturer, you can ask me on the groups or anybody, right? Because I do not expect this to make immediate sense, immediately. So you grapple with the stuff a bit, but because the exam is in a day or two, you might just need to have a template and try to put in the amounts as you see them. And so that is where we are. Right. So I think I'm going to take questions right at the end, which allows for movement and growth and progress. Then finally, I'm going to give you an example. Right. I'm taking you through this example of the lessor. So with a lessor, you need to be able to define a lease, right? Look at all those requirements, right of use, what is meant by right of use and stuff. Distinguish between an operating lease and a finance lease. So I think there's a question 2, which deals with Diamond Lodge, Safaris, that they touch a bit on this. But this is not difficult. And also the gripping textbook has, I think it has a summary somewhere. I didn't consult it when preparing this. Right. So I just wanted to say here, look here, it took me like the whole day yesterday to prepare this because I had forgotten how exactly do you do these things? And I can tell you that even the lecturers, if they give you a template to use an example, they won't go to this detail. But it is this detail that you actually need. You need this detail because if they leave it and they don't teach you this, then you're gonna get confused. And they don't teach you all this. Then you will be confused, isn't it? So it wasn't easy for me, and I want to believe this is accurate because I had a good look, and I think everything is accurate. Like I said, if you feel that something is out, you need to talk to me, or you can talk to your friends as well. They might adjust you or adjust but it's unlikely there's anything wrong here. It's very unlikely. Okay, so I was talking about the finance lease. Distinguish between, you also need to know the accounting treatment of an operating lease. You should be able to discuss that. So if you are in class, no, for those in class, I think I gave you these examples, several of them. Right. Especially in terms of a discuss the accounting treatment of this, that's going to be a bit difficult. Then deferred tax consequences. But for us, we aren't going to focus on the deferred tax consequences the way we normally do because it's here, right? The deferred tax consequences. using the income statement approach. This is everything. I think this is everything you need to know. And all right, I think that's everything. And then the gross method of accounting for the lessor, right, and the deferred tax consequences, it's a year again. So that should be fine. Then I'm going to take you now through an example. So this is an example of the lessor. Now I included this example because some students were crying about on WhatsApp, on Telegram. So I'm not in note of that. So I thought, let me just include one example. So I'm going to take you through this. It's very small. So you may just follow along as I read. So we have a company called Quota Limited, right? And their year end is 31 December, right? So this entity, Quota Limited, they bought equipment to be used in the manufacturing of quota breads, all right, from some guy. They bought that on 30 June 2016 for 1,300 cash. So this is 30 June 2016. You will remember that we start calculating depreciation when an asset becomes available, okay? For use, whether it was used during the same period, that doesn't matter. But as long as the asset becomes available, we can start calculating accounting depreciation. And when the asset is brought into use, we can start calculating our tax allowances or wear and tear. So we have 3 dates. We have the purchase date, if it is purchased. Then we have the date available. Then the date brought into use. Okay, so please do pay attention to dates as you read. So this was bought on 30 June 2016. The cash price is 1,300,000. Then commission is 26,000. It was paid for negotiating this transaction. You should know that the purchase price, you add other direct costs of acquisition, the costs that are directly related to the acquisition, so that the asset could be in the position and condition required by management for it to operate. So this is going to be added. Now here's the catch. This commission, SARS might say, deduct this immediately. Did you know that? So SARS might say, this is immediately deductible, but we want to capitalize it. So which means we have to deduct this here, right? We have to say anything else which SARS wants to be for immediate deduction. We have to deduct it immediately. But then if we capitalize it, then any depreciation of that capitalized should be added back, all right? Because we are required to immediately deduct. So we are watching this here. But now for the asset, so the asset would have a cost of 1,326. And the tax base of this asset, the base cost rather, or which is the tax base, all right, is the best cost, my apologies, is 1,300. So the best cost is the cost according to SARS. And SARS doesn't capitalize the 26,000. They said, do not capitalize it. So when we calculate a wear and tear on this equipment, we calculate the wear and tear based on the 1,300,000. But when we calculate depreciation, we calculate based on 1,326. So that's already a difference. Somebody says, do it now. We wanted to do it later. Okay. So that's nice. I hope you can make perfect sense of that, because you didn't read this in advance. So you need to be able to follow with me as I go. Now, due to an increased demand, whatever, they purchased a new equipment on right at the beginning of 2018. And this equipment was acquired for 1.6, same day. Then they expect this will be will help them to make more bread, right? So that is fine. So the new one is 1.6. And then we will apply the allowances as well on the 1.6. Okay. Then commission amounting to 30 was paid to Agent Limited. So remember that again. If you remember, this commission here of 26,000 was paid in 30 June 2016. So maybe this was done with already. We cannot deduct it now. So please do pay attention to the dates. But this is now being paid in 2018. So we need to know which year are we dealing with our financial statements, which was our reporting year. Right. So if our reporting year is 2016, then we're going to deduct this immediately if the information says so. Right. So we're going to capitalize 1,600 plus this, so we have 1,630. Then the company calculates depreciation on property, plant, and equipment on the straight line method over their estimated useful lives, in agreement with the tax allowances granted by the South African Revenue Service. So the useful life is 5 years. And SARS also does 5 years. The directors of Kota made a decision to enter into a lease agreement with Bake. So on 1 May 2018, right, the equipment that was originally bought on 30 June 2016 was leased to Bake as Kota no longer had any use of it. So remember, they bought a new one. So the fair value of the equipment was 850 on this date. The lease is a lease in terms of IFRS 16. Right. So this is the requirements of the lease. Then the required, where am I now? Why am I crazy? So the profit before tax, after taking the above mentioned everything, after considering everything correctly, the profit before tax is 3 million. Right. So I want to add something to this because the question wants us to disclose the above information for the year ended 31 December 2018. So that's the disclosure. Then a calculation of the SA normal tax expense, right, for the year ended 31 December 2018. Okay. So the year end is 31 December 2018. So that's a very good year because counting months becomes a lot easier for us. That's great. Right, so I'm going to take you through the calculations and I want you to understand them. So a reminder that the first machine is that was bought is 1326. So just remember that. Yeah, the first machine is 1326. Then the other one is 1630. This was bought 30 June. This was bought 1 January. Not so. And depreciation is 5 years, which is 20%. Okay. So the year we're dealing with is 31 December 2018. So we're starting from 1 January 2018. Okay. Okay. Right. So what we want is to calculate annual depreciation. We don't have residual value, right? So remember that. So before we start that, I want to say to you This question I copied from one. Is it an assignment? I think a 2016 assignment. I think so. For some semester module or. So I want to say something to you that this commission, by its nature, is deductible immediately. At your level, at FAC3764 level, right, you are not supposed to assume it's immediately deductible. You must never do that. They must tell you. If they don't, leave it. However, in this question, I think they treated it as immediately deductible, right? So you need to, by its nature, it's immediately deductible. But wait for the lecturers to say it is. Okay. So that's because you might see when we are deducting it here, and then you wonder, but where does it say that? Just remember that this is depends on the lecturers. They might have taught you in class, like when you see me say this, I mean that. And then the students who went through the paper would know what the lecturer wants. And then you might wonder. Okay. So if you see it being deducted in taxation purposes, just remember it was implied to the students who were writing the paper understood that even though there was no instruction. But for you, you have to wait for an instruction from your lecturers as well. Okay. But just remember, it's by its nature, it's deductible. So if you see this being deducted for tax purposes and not being capitalized, that's the story. Right? So the first thing we're going to do is to calculate depreciation. So annual depreciation is 20% every year for the old one, 326. Right. So remember, it's 5 years. Instead of dividing by 5, I just multiply by 20%. So I will have, what do I have here? %20 multiplied by 1,326. So every year it's 265, 200. Okay, so this is the annual depreciation. So the depreciation from 1 July 2016 this was acquired, you remember, 30 June 2016. Right. So 1 July 2016 up to the end of the year is 6 months. The year 2017, it's 1 full year. So this will be 0.5. The year, all right. Right. And then it was sold. So they entered into a lease agreement. So that's the selling, right? On what date? On 1 May. So when was the asset made available? Right. So that's 5. Like for me, that looks like 4 months. Is it 5? Of January, February, March, April. That looks like 4 months. Right. It was made available on the 1st of May. That looks like 4 months to me. Okay. And then, so what am I doing here? I need to calculate depreciation so I can know the carrying amount on the date that it was transferred. Right. So I'm going to show you how that is done. Right, let me go. So what I want to start by recording the, I want to start by recording the, what is this? The transfer of this, the derecognition of this asset from PPE to being leased out. okay, using the gross investment method. So I just want to demonstrate. Let me go to I think I have it. It's this one. Right, so the original cost was 1.3 plus 26. It's 1326. Then at the beginning of the year, remember we had the 0.5, the first 6 months in 2016 and the full year in 2017. So by that time, it was 18 months out of 12, right? And this is the annual depreciation, right? Multiplied by 1.5. So we get 397,800. Then depreciation for this current year. Why are we doing this? We need to determine the carrying amount on the date it was leased. It's just for 4 months. If you want a reminder of the 4 months, this was on 1 May this year. So we have January, February, March, April. So we need to calculate that depreciation for the 4 months during this current year to update the carrying amount, right? So that depreciation for the current year to update the carrying amount. Because this two would give us the carrying amount at the beginning of the year. So this would be the carrying amount at the beginning of the year. Right? But now we need the carrying amount on the date of sale. Right? And so we need to update the depreciation with an additional 4 months. So this is the current year depreciation. And then we subtract both depreciations here. And then we have carrying amount on the date of lease is 839. By saying 1326 minus 397,800. So this is the cost 1326 minus 397,800 minus 88,400. So we get this 839 as the carrying amount on the date of the lease. Right. So if we are supposed to account for this lease, for the leasing of the asset using the gross method, right, for lessor, the starting point is to to update the depreciation. Right. So there's a depreciation expense for the current year, and we have to debit 88,400 to the depreciation expense. So remember to always indicate whether it's a statement of profit or loss or statement of financial position or changes in equity or other comprehensive income. You need to indicate which financial statement we're looking at. So the first journal entry, if relevant, would be to update the depreciation. So update that accumulated depreciation updated. Now the combined depreciation is 397,800 plus 88,400. 486. Because we are now de-recognizing the asset, we're going to debit accumulated depreciation of the asset. And we're going to credit the equipment at cost, the total cost. Right. And we're going to remeasure this asset to its fair value. So you will remember here, they say the fair value of the equipment was 850,000 on this date. So if we come here, we recognize the asset at its fair value and the gain in the asset, which we refer to as profit on disposal or valuation gain, is 10,200. Okay, so what I've done here is slightly different because I've included another entry, this one. You normally don't get it in your study pack, but it makes it easier to follow what's happening. This asset is being transferred from being measured at cost to being measured at fair value. So we remove the cost and the accumulated depreciation, and we reintroduce the asset at its fair value now. So it's now being measured at fair value before transfer. And that results in a gain of 10,200. So where does the 10,200 come from? It's the balancing figure, right? Because on the debit, we have depreciation, accumulated depreciation, and equipment at fair value. Then on the credit, we have equipment at cost. Then the balancing figure is we balance both the debit side and the credit side. Okay. So the balancing figure could be a loss if it was here. It was going to be a loss. In this case, it's a profit, a gain. Right. With that asset now, we now come to account for the transfer of the asset. So this was just remeasurement of the asset at fair value. So we removed the original cost, original depreciation, and we reintroduced the asset at its fair value. Now we're going to list out the asset at its fair value. So equipment at fair value is being listed out. So now it's going out at 850. And the gross investment is the total gain, the total payments we expect to receive, the lessor expects to receive. So it's going to be all the payments, including the installments, plus the guaranteed residual value, plus the unguaranteed residual value. Everything that the lessor will get is the gross investment. Okay, so that's the gross investment. So we are giving away 850. So we are selling something worth 850 for 1053,498. So we're making income of 203,498. But we haven't earned that income yet. So it's an earned finance income. Okay. And remember, this income, when it's earned, when we earn the income, it's going to be included in profit or loss as income from lease. And when we deal with calculating current tax, we need to deduct this income and include the actual lease payments received. You will remember that. So this income that we're going to get here, finance income recognized, we have to deduct it, to remove it, because we should be taxed on the actual lease payments that have been received. That's what SARS wants to be included, not this, which we're going to calculate based on the amortization table. Okay, so this is what we do. So if there were some costs incurred in arranging for this lease, they would be here. So this is your accounting for the transfer, just the transfer of the asset. Okay, I don't think it's difficult. That should be something easy to follow. Then, so I'm going to take you through something here. So now we need to calculate so just a quick reminder. All right. So we have calculated depreciation, you remember, and it was 88,400 for the current year. Right. But we haven't calculated depreciation for the new one. So the old one, depreciation for the old one is 88,400 for the current year. Right, where we said 20% multiplied by 1,326 for the 4 months. Right. Now we have that 1,630, which was bought right at the beginning of the year. This 1,600 plus the 30. So it will be 20% multiplied by 1,630. Right, so we will have 20% multiplied by 1,630. And that's for me 326,000. So this is the depreciation for the new, which was bought right at the beginning of the year. This is the depreciation for the old, which was bought 30 June 2016. All right. Um, right. So now what we need to do is to calculate the interest rate implicit in the lease. Why do we need to calculate the interest rate implicit in the lease? The interest rate implicit in the lease allows us to allocate interest and interest income. Basically, that's the reason why we need um, the interest rate implicit in the lease. For the lessor, we need to determine the interest income. For the lessee, it would be the interest payments that we need to determine using the interest rate implicit in the lease. So we need to calculate that so that we have an amortization table, which will tell us for each payment, how much should be allocated to finance income. So that's why we're going to calculate the interest rate implicit in the lease. So your arrear will be N is equal to 3 years times the number of payments per year. So it's every 6 months. So 2 payments per year gives us 6. Right. Then the payment 175,583. So the first payment to be made 31 October. So this is in arrears. All right. Um, uh, then the last payment on 30 April 2021. So the present value is the fair value of the asset being given up plus the initial direct costs. If this is not a dealer lessor or manufacturer lessor, right? And we have it as 850,000. There's no initial direct costs here, right? And the future value for the lessor would be the guaranteed residual value and the unguaranteed residual value. What is the lessor going to receive at the end? So in this question, I do not see that. So the future value will be 0. I'm not going to worry. I don't want you to worry about what answer you get actually, because I don't want us to go into the calculator details like where somebody will say, I get a different amount here. But I want to demonstrate whatever amount you get, the correct way to use that. So if we do that, right, then I do not know if you will get 13% per annum, but you should. But whatever you get, you could get a 6 monthly rate depending on the setup on your calculator, or you could get 13% per annum. Right. So now we have the interest rate. Why do we need the interest rate? It will enable us to know how much finance income to put in the profit or loss as finance income. Then calculating an end finance income. This is the gross investment we're going to make. Then the net investment in the lease is the present value of the lease. This amount here. Right. So that's going to be the net investment in the lease. So what this means is we are investing 850 so that in the future we will get a total of 1053,498. And then the difference is going to be interest. So it's like you give your friend 100 rand, then your friend gives back 120. So the 20 is going to be interest. So you will receive 120 after giving out 100. So the difference is the interest, financing income. So you are giving away, you will receive 1053,498 after giving away something worth 850. So the difference will be the interest, but it's not yet earned. So that's the unearned finance income. Right. So I want you to follow. This is important. I want you to follow this. Um, do you see? Payment is made. Payment is made on 31 October 2018. Do you understand that? Then the year ends 31 December 2018. So which means that when the year ends, we have 2 months, November and December, 2 months, for which we haven't received payment. But the interest has been earned. It will be paid on the 30th of April, but it was earned for November and December. So when we report at the end of the year, 31 December 2018, we need to remember that there's 2 months, okay, for which we haven't received payment because the payment is scheduled to be paid on the 30th of April, right? Every 6 months, 31 October, 30 April, 31 October, 30 April, until we reach 2021. Right? So I want you to understand that this is a case when payments and year-end dates do not coincide. So there's a date the payment is made, there's a year-end, and these do not coincide. So there's an extra months which we have to pay attention to. This is the 2 months here. So whenever we have a balance on 31 October after paying, we need also to remember that there's an additional 2 months for which we haven't received payment. And that 2 months interest should be added to the balance. Right. So I want you to follow very most carefully as we go through this. So we have the interest rate being the IREL being 13%. We're paying 175 every year. And here we're starting at the present value of 850. Okay. So we start with, this is the date, the installment is here. The interest rate is 13% per annum. This is the column for capital. This is the balance. The lease started on the 1st of May as given, 1st of May 2018. And the balance is the present value or the net investment in the lease or the present value of that, which will be the fair value of the asset plus the initial direct costs. All right, so the fair value we are given is 850. All right. The first payment happens on 31 October. That is after 6 months. We have May, June, July, August, September, October. So we have 6 months. All right. And so we receive this 175,583 after 6 months. This is what is actually paid by the lessee. But we need to calculate the interest. So the interest is for the 6 months on the balance at the beginning of the 6-month period. Right. So it will be the balance at the beginning of that period is 850,000. And interest is calculated at 13% per annum. So you need to remember whether your percentage is per annum or it's periodic or it's biannually. If it is per annum, then you multiply by 6/12. Because this is for 6 months out of the 12. We are using an annual rate, and it's only for 6 out of 12. So the interest accrued or accumulated is 55,000, right? $55,000 is going to be the interest. But then these guys pay 175. So the difference between these should go to the repayment of the balance. So 175, 552 minus 55250. So we have 175 okay, minus 55250. This gives us, so if you, let me just do a calculation here so that we can move together. I do this, not everybody struggles with this, but it's because some students were asking, what's happening? And it was a case where the payment does not coincide with the year-end date. So we have 175,583 minus 55250. Then we have 120,333 being repaid. So if we repay 120,333, we started with 850. Then we repay 120,333. Then it means we are left with 7,29667, right? The payment is 175. 55,000 goes to interest. Then the rest should be used to repay the original. That is 120. So if we repay the original, if we pay 120, then we are no longer left with 850. It's now 729. So this is the balance of the for the next 6 months. But however, the year is going to end here before any payment is received. But the interest has been accrued. The interest has been earned. Yeah. But no payment was received. So at year end, we need to report the position. So the position is the balance plus unpaid interest. So this interest is for 2 months, November and December. So we go like 729, the balance at the beginning, 729 multiplied by the interest rate, but it's just for these 2 months only. And remember, no payment was made. So it's 15,809. So the balance was 729 after payment, but we also have an additional amount which was not received. And so the balance at the end of the year is 745, having increased by this 15,800, which was not paid. Okay? Now, when we pay on 30, when they pay on 30 April, they're going to pay 175,583, right? But the interest for that period, for that 6-month period, is 13% for 6 months, but based on the balance at the beginning of that period. So the balance at the beginning of the period is this amount. Then we have November, December, January, February, March, then April they pay. So that's 6 months. So at the beginning of that 6-month period, the opening balance is 729,667. Okay. So I have 729, this balance here, 667 multiplied by 13%, multiplied by 6 out of 12. Then I have something like 47, 428. But this is for 6 months. This is for 2 months. Then the other 4 months will come here, right? Because this is for the whole 6 months. But the other 2 months were part of this reporting year. So we're going to split them into 2 months for the last year, right, which was reported here, and these 4 months, which will be reported in the 2019 year. So for the 4 months, it will be the balance at the beginning multiplied by the rate of 13% just for 4 months, because the other 2 months were accounted when the year ended. So we're now waiting for we now want the other 4 for the following year. Right? So it will be 729,667 times 4 over 12 times 13%. Remember that it should be 6, but the other 2 were already accounted because we wanted to close the year. and we needed to take into account everything earned during that year. Then the other 4, but the other 4 is still based on the original balance of the 6 months, not on the 4 months, on the original balance of the 6 months at the beginning of the 6-month period. All right, but then we account for only 4 months. So it's 4 divided by 12. Then we get 31619. Okay. So how do we now determine the right? So from that we pay 175, and these 2 guys is the interest, isn't it? And then the capital repayment is this amount, and this is the balance we have. Based on this balance again, we calculate for 6 months, we get this, right? Then this is the balance, and this is the capital repayment, and this is the new balance. But this is paid in October. So we also need to account for the 2 months, November, December, for which no payment is made, because we want to report now. So this one, which you see a dash for which there's no payment, is just for reporting purposes, for financial reporting. Right? It's not like we made payment. Okay, so I wanted to practice this, and I said in your FAC3664 under leases, they give this to you very well. I say so because I haven't used the gripping textbook recently. I last used that in 2023. So I wouldn't be able to point you where exactly. Right, then when you disclose, when you prepare your income statement, your statement of profit or loss, for the year ended 31 December 2018, your interest will be these 2 guys combined. It will be 55,250 plus 15,809. So you're going to add this plus that. So 55,250 plus 15,809, you get 71059. Okay. And this is the interest income that you should include in profit or loss. And that's the purpose of preparing this amortization table. We need to know how much finance income to recognize. So finance income would be 71059 in the profit or loss. But now when you prepare the current tax, you need to reverse this, you need to deduct it. It was added, you need to deduct it and actually include this payment, the whole payment, as the income. Right? The whole payment should be included as the income. So that is if you are using the income statement approach. You remember that explanation when you say the finance income that was recognized using the amortization table or using the straight lining if it was operating lease, you need to remove that and actually include the actual payments received. That is what is going to be taxed. Right? So I think I've covered everything here. So I'm going just to show you quickly how we do the rest of this. So we are told that the profit is 3 million at the beginning, after everything, the profit before tax, everything considered. So now, right, so this is just a disclosure, right, of net investment in finance lease. It's not difficult. It's just a disclosure of the stuff we already have. So during the year, we started a lease with 850. Then we have this finance income end. You remember that those 2 amounts we added together, right? The first 6 months plus the 2 months combined. But we received payments of this amount, and this is our balance. So it's just a disclosure. You can take this. These amounts are here. So we are basically saying we started the year with 850. Then we have income end of this amount. Then we received this payment. That's why we have this balance here, 745,476. Right. So basically that's how we just reporting that. during the year we had this lease, then it increased because of the income, but we received payment. So where we're standing now is here, right? So with new leases entered into, then the finance income end is added, then the payments received are deducted. Then we are here. Then maturity analysis of the financial lease instruments receivable at reporting date. So we are saying in 2019, the whole of 2019 financial year, we're going to receive two payments, one in April, one in October. Each will be 175,583. So we're going to receive a payment in April and another one in October. This is for the year 2019. So the total received is going to be equal to 175,583 times 2. So that's why we have this. This is what we're going to receive in 2019. Of that amount, how much will be the interest? So the interest for that 2019 year will be, so you come to your amortization table. So the interest for the year, financial year 2019, is this amount? Is this what? These four amounts, no, sorry, this 4-month period, you remember that? Plus the 6, plus the 2 months. Correct. This is for January, February, March, April, 2019, 4 months. This is up to 31 October, 6 months. This is November, December, 2 months. So we're going to determine how much interest will that be. So that will be 31619, we add in here, plus 39098 plus 10076. So we have 80, right, 793. And then the balance is the net investment finance lease. The amounts still to be received. The repayment for that period should be 270,373. Then we do the same for 220. We receive this not for 220, for 2020. Then the unearned finance income will be for 2020. It will be this amount for the 4 months, this amount for the 6 months, for the 2 months. Okay. And on and on and on. Then we have done our maturity analysis. Finally, we come to a final discussion of the current tax calculation. This is just a demonstration using the income statement approach. So we are given, this amount is given, like assume after all transactions were taken into account, everything, we have 3 million. But remember that there's a profit on sale when we transferred the lease. Remember, there's a profit on sale of 10,200. If you still remember that, we transferred the lease and we transferred the equipment from PPE to its fair value. And we gained 10,200. But SARS doesn't want that to be taxed. It's not yet income. So we need to remove that. Accounting profit or loss is going to be reversed. So here it was income, it has to be deducted. If it was a loss, we were going to add it back. Then the finance income, you remembered, we said those two amounts, these two amounts combined. This is what we include as finance income. But we need to reverse that to say, no, we are not going to do that. We need to include the actual installment received during the year. In this year, it was only one. Right? But in 2019, there will be 2 installments received. We include that as the actual amount. Then depreciation, you remember the depreciation of the old one, 88,400 for those 4 months times 20% times 1,326. We did calculate this. And it was 88 plus the one for the new one, it was 326. If we combine those two, the depreciation would be 414. It was subtracted as an expense. SARS wants you to add it back because they want you to subtract the wear and tear. So the wear and tear is based on, so we have two. The first one is 1,300. Remember? And we added a 26 commission. But I told you commission is not added. Then the other is 1,600. Okay. So now this is what happens. So we have one for 1.3, 1,300. The other is 1,600. Now I just want to make something very clear for you. Right. There is this thing called pro rata. There's this thing called not apportioned. So they would tell you what is not apportioned or what should be apportioned pro rata. So pro rata means you have to calculate the number of months something was used. If it is not going to be apportioned, even if it is used for 2 days, we claim the full amount that is required annually. Right. So in this case, the information was not given, but this is a case of manufacturing equipment, and that section, manufacturing machinery. So don't worry about that. We just assume that there's no pro rata. The information doesn't say. The information doesn't say. Or maybe when I was preparing this, I forgot to copy the rest of the information under additional information because it was a question with other stuff. So I didn't copy everything. So it might be my error in copying. So it should say this is not prorated and this is deductible or not deductible. So this is not going to be pro rata. So if we use it this year, whether for 1 day, we claim the full allowance. So we sold this one out, right? But we list it out. And because it's still ours, we can deduct the 260. But we can't deduct the 260 because it's a lease, right? Remember that. We are receiving 175 this year, and we want to deduct 260. For a leased asset, they will say, no, you are limited to section 23A. So you deduct the lower of the wear and tear or the lease installment received. So which one is the lower? So you deduct the lease installment received. So if the lease installment received was higher, then we would be allowed to deduct the 260. So we are not allowed to deduct more for that particular asset. For that particular asset, we cannot deduct more than we are receiving in that particular year. Right? So do pay attention to that. But for the new one, it's not being leased, so there's no problem. This is only for leased out assets in a finance lease. Okay. So we're not allowed to do that. Right. So the wear and tear we deduct for this one is 320 because it's for 5 months. And then the commission, I said to you, you have to wait for information. But pay attention to the fact that it's not going to be capitalized. So it says to be deducted immediately. So you see, if it is deducted immediately, it's not going to form part of the tax base. So the tax base will be 1,300. And the cost will be 1,326. The tax base will be 1,600 for the other one. And the carrying amount would be 1,630. Because the 30,000 here is capitalized. But SARS wants that deducted immediately. So this will be deducted. And it won't form part of the allowances because it's not being capitalized. So I think it's my mistake because normally, you know what they do is that at the end, they will say additional information. They will start talking about this other stuff. So I think I didn't copy that. But you just have to pay attention. So this is what you do when you're dealing with the movement in temporary differences in a list. Okay, so I'm going to stop here. I think the topic of revenue is quite doable. You guys can manage your revenue on your own and you will be fine. Right, so I have recorded this. For those who would like to have the recording, it will be made available on YouTube. So for those who are interested in classes, right, we are a private tutor called Resource Hub. It's not one tutor, it's plenty. That's why it's a hub. So it's a meeting point for a lot of tutors. And I'm the most active because I'm the oldest there. But we actually a lot of us. So if you want us to help you in any module, please do talk to us. And if you have a specific question, just ask on the group in WhatsApp, on the group on our Telegram group. Then we get time, we'll be happy to assist you. Now I'm going to take questions from you, either on the presentation I've made or based on your study pack. But before we do that, we're going to allow those who would love to leave. And at the same time, I'm also going to stop the recording and then we can have these extra discussions for about an hour. So thank you very much. For the next 2 minutes, we're going to allow those who want to leave to leave. Then we can have general questions from you for any concept. Thank you very much.